July 24th, 2020, almost 6 years ago. That's the exact day this journey started with $0. Fast forward to this morning, June 3rd, 2026, and the portfolio has officially closed at a total market value of $256,092.15. But the milestone I am most proud of is right here. We just officially crossed $24,254.24 in lifetime dividends earned. What's truly wild is the sheer velocity of this engine. When I ran my raw historical ledger, I discovered that 65.68% of those dividends, over $15,580, were earned in just the last 12 months. We are moving from a slow crawl to a vertical climb. In this video, I'm going to show you the dividend anchor strategy and how I built this income machine by completely breaking the traditional rules of investing. Let's look at the absolute powerhouses anchoring this portfolio. My Palantir position has grown into a massive 514 share powerhouse, sitting on a total market value of $78,240.15. My average cost is just $21.05, meaning my raw tax lots are up 622.84%, while the dynamic money-weighted return tracking on my M1 dashboard shows a massive plus $80,075.44 total gain. Right underneath it, look at NVIDIA. I only hold 84 shares, but because my average cost is a rock bottom $15.01, the position is worth $18,747.61 today. On my M1 interface, that represents a jaw-dropping 1,817.34% performance gain. Traditional financial advisors constantly preach about rebalancing, selling down your star players to buy your worst performers just to keep your portfolio percentages neat. If I had listened to them, I would have capped my own growth and taxed my success. My rule is simple. Never rebalance your Goliaths. You let your winners run. You don't bench your top scorers just because they're winning the game for you. I want to be completely transparent on this channel. I've made mistakes. Last year, I experimented heavily with ultra-high yield funds like YieldMax's ULTY. Looking back at my ledger, that experiment brought in exactly $2,427.59 in cumulative dividends while I held it. But I quickly realized that chasing the highest yield percentage blindly is a dangerous trap. Look at my remaining YMAG position right now on the screen. The dividend yield looks incredible at over 51% on paper, but the underlying asset is down minus $1,392.76, sitting at a negative 18% return on my sheet. This intense principal volatility is exactly why I cut ties and exited ULTY entirely. Chasing yield without a high-quality anchor will eventually sink you. But if you want to know why I still keep YMAG around, unlike ULTI, I'm still up 644.73 if you cancel out the dividends earned and the market loss. So that's why I didn't sell it, because it's still up about 12.20% money-weighted return. So this is my track my dividend screenshot of the summary of my portfolio showing annual income and yield on cost. As you can see, instead of chasing yield traps, I shifted the bulk of my income capital into institutional stability, funds managed by elite firms like JP Morgan and Goldman Sachs. Look at JEPQ on my screen. It gives me incredible monthly income, but unlike the ultra-yield funds, the share price actually grows, sitting on a profit of plus $541.61. When you combine this with Goldman Sachs, GPIQ, and my NEOS funds, you get a rock-solid foundation. Because I let my growth winners run and built up these quality income assets, my total portfolio yield on cost is sitting at a massive 10.94%. This portfolio has officially crossed a major milestone. $15,982 in projected annual income. That breaks down to over $1,331 every single month in purely passive cash flow. Here's an FYI on the strategy how I fund the portfolio. With about 83 holdings in this portfolio, which is a lot by the way, and I do it because I love seeing those dividends hits more often in the morning when I wake up. It's a psychological thing to get me to stay motivated to invest. I don't use auto invest, and I never have it set to automatic rebalancing. When the dividends hit my cash balance, I just act like a sniper. I wait on red days when my foundational assets or core ETFs take a dip. I step in and manually deploy that dividend cash to a certain or specific stock or fund to lower my cost basis or to add on to a position that I believe could use a little more capital boost. This is how I balance and the portfolio on my own terms. I don't force a sale on my top performers like Palantir or NVIDIA. If I did, it wouldn't be where it is today, and I'm super grateful for that. Instead, I use the cash flow generated by those dividend pairs to buy the dips or add more on the rest of the team, or sometimes I use it for my living expense. I am the active manager of my own private fund, and so far it's been working out great for me. This is the ultimate power of the dividend anchor, letting my growth run, avoiding the rebalance trap, and sniping the dips manually with institutional grade assets. The math doesn't lie. The snowball is officially rolling. So if you want to continue to watch this method grow bigger or to the next level, hopefully hit that subscribe button. Stay disciplined, and I'll see you in the next update.